Hi, good morning, everyone. Uh, Welcome to today's Fireside Chat. Well, I think it's more rain side. Today, it's been raining the past few days in Mumbai, and we have attendees today from all over India and all over the world. And really, thank you for joining in this Saturday morning. So let me tell you a little secret about working with your spouse. It's like a therapy session 24/7, but no psychiatrist is willing to intervene rather over here. But I think Amitabh's life after joining me I think it's become easy. It's much easier to manage only one boss, ghar pe bhi and office mein bhi. So we both come from very diverse backgrounds. I've always been in a client interfacing role, and he comes from a corporate banking role. And I think as a couple, we have diverse backgrounds, and we try to add value in different ways to our clients. And you know, we try to help them with our personalized and professional approach and offer solutions to us. Believe me, personal finance is much easier than understanding Oppenheimer. I'm sure a lot of you have watched that now. And we have an exceptional team, and some of them have been working very closely with our clients. I think now I can say friends over a long, long period of time. So Amitabh and me now we manage over 300 crores plus of assets under management. And once again, a big thank you for all your support in our journey. I think we have been at the forefront of offering you very new and innovative solutions. And I think the newest one being the transaction which we did through Gift City. We'll brief you on that in the coming days. Coming back to the event today, we have with us Debashish Bose. Debashish is the founder and portfolio manager at Oaks AMC, and he runs the ABC portfolio there. He comes with about 23 plus years of work experience, and he's an alumnus of IIM Calcutta. He's worked with marquee organizations like DSP Mutual Fund, IDFC, Quant Capital, UBS, and Kotak Mahindra. I think I would like to mention about the outstanding performance of Oaks PMS since its inception in January 21. It has consistently beaten the benchmark of Nifty 50. And I think especially in the last 1 year, he's beaten the index by almost 10%. So that's been absolutely great. I would like to again thank you again for taking out time on a Saturday morning for us. And I hope that you find this session interesting and a value add. We'll be, of course, keen to hear your feedback on this so that we can improve and work on our subsequent sessions. Yes, we plan to do this more often going forward. So now let me hand over to Amitabh and Debashish so that they can begin today's session. Thank you.
Hi, thanks Anureka for introducing Debashish. Of course, I'm not going to go anywhere close to what you said, working with spouse, etc. As you said, boss is always right. And I close a topic on that. So, yes, we are indeed privileged to have Debashish here. And I've known Debashish now for many years, not just since when he started Oaks AMC. And we have had very interesting debates, starting from the quant-based solutions to we have brainstormed a lot on the retirement solutions. And here we are debating the growth in per capita income and so on and so forth. So I value and cherish the discussions I've had, and therefore we thought that this conversation might be of interest to several of our valued partners who are here. Thanks a lot for joining us today. So let's start with the most important or burning question. Markets at an all-time high. What is your take on that?
The $1,000,000 question. Thank you, so much for doing this, and always, fun interacting with you. I think, markets will keep hitting all-time highs. They've done that since the time they've been around. But at any point in time, it's pretty important to just set context. And to set context, what I really try and do is, look at it from a very, very near term, look at it from a slightly more medium term and a slightly more longer term. And we could run it in that chronology. From a very near term, I could say that, okay, if January to March of this year was a period of a fair amount of doom and gloom, it's kind of gone the other way, barring the last 3 days. Right? So these things happen in markets. And I think these swings will keep happening with a fair amount of frequency just because of the sheer amount of changes happening globally. Whether it's taking supply chains out, transitioning energy, all of these big things, which at the end of the day are all about currency. And currency is all about how you look at money. And money is all about how you value things for that money. So as those things fluctuate, it is part and parcel that, these things will happen. But yes, coming back, in a very near term, yes, it will look that if things were gloomy, but if you were buying at that time, if you happen to buy at that time, and now it's sort of all gone vertical, then you're, automatically wondering what it is. And it's possible that at this time, a certain amount of correction should happen. It's already happened. And that's a healthy thing. Let's widen out a little bit more and see from October 21 till about April 23, which is a good 18 months, we've actually had a flat to slightly bearish market. So when you look at it from that time frame, it's not done a whole lot, right? It's only about, say, 7 or 8% above wherever those highs were, which if you now break it down over a 18 plus, say, 3 or 4 months, so give it almost 2 years, you're practically about 2 to 3% up year on year, roughly. Also, keep in mind, I think what they did in this March when they changed the rules on taxation for debt, the capital gains set-off limits for real estate, insurance premium limits, again, for the tax shelter. And when you MLD is coming back into this thing, which meant for a certain section of society who's probably paying the 30% tax rate and above, what are the options? Where do you go for putting in, a certain amount of capital, which is liquid, tax efficient, and able to give you a certain return? So I just see that where is the choice? If I also evaluate a lot of folks we talk to, which is typically a fair amount of these family offices, ultra high net worth individuals, etc., I saw them being fairly static for this entire October 21 to March, April 23 period, in the sense that whatever they're allocated, there was very little incremental moves happening. And I'm seeing the first reaction happening now when the sign of correction happens is actually money coming back. So my first thesis really is that I think corrections in the very near term will probably be shallow at best, simply because people will come in and participate, simply because there's not a whole lot of choice. For a foreign investor's point of view, also, there's been a whole drumming up of the India thing in the last, I would say, again, 3 months. Within that, there's been this little shock of inflows which have happened. And then, okay, maybe a little bit of that has gone out. But again, chances are, when you take a particular position as part of a large institution around the world, you can't like flip-flop every. So usually whatever trend is there in a year is likely to continue till the end of the year. As we cross the year, it's a new year. We'll think about it at that time. And thirdly, and where we really sort of span it out a little more, is that, okay, if we are saying highs should be a bit of an issue, then we should also say correspondingly that growth of GDP should be an issue. And we should not grow that GDP at all. So that will never, jive. So as these things move up, the markets will also probably trend up, because it's so much easier to move markets than it is to move actual economies. There will always be overshoots and undershoots happening. And I think we live with it. So even when we manage money, what we go with the assumption is that any point in time, 20 to 30% correction can happen. So how do I plan for that? Like if I'm running into highs, how do I plan for what the downsides could be, and therefore keep myself ready for that situation? So you just have to inbuild that whole thing that this will happen. No one will truly know which way markets go.
So
And just run with that.
Like a typical fund manager, you've given enough commits. But what I'm hearing from you is that it may not be appropriate to look at it and say that the market is at an all-time high, unless if you're looking at, or very expensive.
And also keep a point here, all-time high in which currency? Right. In dollar terms, it's not.
Fair. Fair. So basically, so markets are at a high, but it is necessarily not at a very expensive levels. It is not necessarily something we need to be worried about at this point of time. Whether it's the flows coming in, there is still enough going for the market to move up. Short-term corrections, nobody can control, and that's something which is given. But if you look at the medium term, that's what I'm hearing. That's right.
No, you're right. And just to add to your point, at the beginning of this year, we were talking to a whole lot of folks, and the general thing we heard was, oh, yes, India's okay, but the Nasdaq's corrected a lot, China's corrected a lot, let's put money there. So good, bad, doesn't matter. The flows went there.
Right.
Whoever we were speaking to within India was looking to lock in fixed income at about 8%, give or take.
Right.
So equity either way was cracking through falling through the cracks. Move forward, post Adani, post Silicon Valley Bank, all of that. And where is the choice now? So I go back to flows more than anything else. That,
right. So let me touch on a slightly different point. You touched it, but you just skirted around it. Was that the GDP and the market don't always move in sync? So GDP really comes back to corporate earnings. Because ultimately we say that in the long term the market mirrors the corporate earnings. How do you see the corporate earnings, and how do you see that panning out over the next 12, 18, 24, 36 months? Because that would have a bearing again in terms of the market, irrespective of what happens in elections, etc. Everything which is there in the future.
Sure. I think, again, let's just keep the markets and the earnings aside, because usually the markets will do whatever they have to do.
Correct. So let's
either way.
Agree.
The earnings, the way we saw it, is that broadly anything consumer facing, and especially at a more mass level, is a little weak. It's not changed a whole lot over the last 2-3 years, despite a little bit of COVID bump here and there. It's been a little weak. No one has a very clear answer why that's happening. None of the commentaries seem to suggest that. On the other hand, we've seen some pretty high growth in personal loans, which also now seems to be worrying both the RBI as well as the likes of Bajaj Finance and all of that. My guess, and in fact in our team also, the hypothesis is that of late, I think the EMIs have just gone up. And by that, I mean not just existing EMIs, yes, they have repriced a bit, but also new EMIs coming in, because so many people have bought apartments in the last, post-COVID.
Right.
Let's put it that way. Also, there's been this big bump up in auto sales. But which automobile today is priced below 15 lakhs? And no one thinks of it as having 15 lakhs or 20 lakhs to buy it. Everyone's thinking in terms of cash down and then EMI after that. So I think that's what's happening, which is impacting discretionary consumption or, even staple consumption to some extent. So that's there. On the other side, I think things which are being driven broadly by budgetary flows of the government towards the broader sort of capex building, infra building, logistics building, I think there the order books seem to be very, very strong. So I think this divergence is there. Our thesis, of course, is this is a much bigger divergence, and there are reasons behind it which we can touch on down the road. But very broadly, that's what I see.
In a lot of discussions I have been having with folks in the financial world, that the economy is moving a little bit more K-shaped. And even within the consumption trends which we talked about, the luxury consumption items, those which is aspirational consumption, those which is linked to the per capita income going up, you're seeing that trend to be much more stronger than the other staple. And maybe those, we will see it over the next few months. Hopefully the monsoons, it has been, like I mentioned, it was pouring the last 15 days. Hopefully, if monsoons are good, then that might pull up a bit of rural demand, etc. Anyway, time will tell. We'll see that as it unfolds.
I think keeping in mind that there are two constants in India, like religion and weddings. So those will always have their own sets of demands. It could just be that, people also save up for that. So things sort of fall off in between. But something else is obviously impacting. Our thesis, like I said, is higher EMIs, but we'll see.
Sure. So you also talked about market in USD terms, which then brings me to a very recent event which happened in US, the downgrade of US by Fitch. And there's some commentary that it's passing wind. It's something which the market seems to have shrugged off in 2-3 days as well. But your take, is it more temporary? Is it something which we need to watch out for? Is it something which we need to take note
of? So again, very, very near term. Most institutional players were sitting short on the bond markets. So they were probably already anticipating this was going to be happening. We've seen bond yields also move up from about 3.5 on their 10-year to about 4.2, 4.1, whatever it is now. But the similar moves across the 2s and the 5s. And what Fitch was doing was simply following what S&P had done. And I think Moody will probably, whenever they might have done also for all we know. I don't think it really matters too much from the point of view that, okay, people are trading these things. But today, even if you were to take out money from US bonds, where do you put it? So structurally, over a period of time, if Western economies will need to keep printing money and shore up these markets, that could always happen. But I won't read too much into rating agencies and their visions of the future. I mean, there are many things to worry about. I don't think this is the one necessarily to worry about.
Okay. And in terms of the global flows which have been coming in India, which are, as well as, is there something which, as what you're trying to, what I understand is that it really does not matter with the rating agencies. Whatever flows has to come to India will come irrespective.
Yeah. So I think let's break it down into a few things. Our impression of what India is versus what the impression of India is from an investor's point of view, I'm putting it here, and its relevance in the global markets are two completely different things. Our impression being is the center of the world, it's anything but when you see it from a global investor's point of view. The only area where it was coming in a meaningful way over the last several years was actually the startup ecosystem, but even that's having its own challenges. And now you have one or two very classic big blow-up cases with governance issues and all of that. So let's see how that plays out. There's a little trial balloon also, I think, which was launched in terms of the taxation for ESOPs of folks in startups where it's domiciled outside India. So these could create complications. Why it's relevant? Because that's a big pool of where the money recently was coming in. In terms of money from the more public market side, it's still, we benefited a little bit simply because in the emerging market part of it, with the issues with China, we got a little more. But keep in mind, emerging markets is just about 15% of overall equity flows. So within that, we got 15%. So that's about 2% of global equity flows, which is probably even lower than what our GDP share is. So it's only as important. How we see it is that next 4 to 5 years, I think where we are putting a lot of the policy efforts is towards building manufacturing capacities for areas where we have import dependencies. If we are able to execute on all this, maybe in 4 to 5 years down the road, our capacities would be up and running and our import balances will start coming down. In that period, we'll need to be competitive with the yuan because we're trying to take. So if the yuan falls, we'll also fall. Post that, chances are we may actually start appreciating. And that's when bigger amount, because foreign money always comes in when the currency looks like it'll do well.
So before we move on to a little more specific, I have two more questions for you. One is around sectors. Very quick, of course, discussing sectors can go on endlessly. But in your mind, which are the sectors which look promising if we look at a 12-month horizon from here?
We look at a little longer than 12 months and we
36 months.
That. Yeah. No, I think quite simply, I mean, what we really try to do is that, look, if a country has to make a transition from a low income to a middle income economy, there's a particular playbook every country has used in the past, which is you start by giving incentives to set up factories. As that happens, people migrate from rural areas to the industrial areas, which has two knock-on effects. One, agri starts mechanizing because labor shortages happen. Secondly, industrial townships come up, urbanization happens, infra gets built. And you need better logistics to handle these bigger ecosystems. And you take these 4-5 big areas, manufacturing, agri, logistics, infra, real estate, is also where 90% of the population is sitting in. So if you create organized employment, growth, jobs, per capita income grows. That's the policy push, if we see. So these are the areas which are really getting the tailwinds. They're also getting global tailwinds because supply chains are shifting and it's triggering off this whole thing. So these are the areas we focus on. They open up many subsectors within them. But that's where we see the growth happening. And I think the results are also in line with this thought process.
Right. So before we get again as to more specifics, maybe let me try and wind up the section on markets per se. For most of our clients, we have been discussing long-term investments. We have been talking of investing for long-term, looking at goals, retirement, and so on and so forth, and how do we plan for it? Which short-term blips does not really matter too much. But still, there are points at which you need to look at asset allocation. You need to look at rebalancing based on what's happening. So your take on this, given as a closing comment on the market, with the markets where it is, and you look at next 3 years, does look that it will continue. Whether you look at booking some profits, rebalancing some funds, looking at any new money being staggered over short term, medium term, any thoughts around that which would be useful for our audience here?
So I think firstly, it's a very personal decision because it's a function of when you came in, what your tax implications are. You also don't want to be in the phase where India is going into this whole growth thing. You don't want to be out of stocks. So it's better not to take very binary views on it. Should, for whatever reason, you need a little money or you need to take a little off the table, you've made a lot, you would feel a little more comfortable if you took a little off the table. Yeah, by all means. Right. But and what we also do is usually, play around with about 20% of our position while we keep about 80%. It may also be a function of how your own planning is happening. And I think that's a more detailed discussion with, a lot of nuances to it. But if you're planning, what are you setting aside for your near term, your medium term, your long term, and therefore, if it makes sense to rebalance within that, I think that's a decision to evaluate, but not necessarily, I'd always say, think these things through, but don't necessarily try and act immediately. Just have a plan for different scenarios.
Fair. So moving to the ABC portfolio, and since we have the luxury of having you here, I won't let you go off without talking about it. The first is in terms of your thought behind naming it as ABC portfolio.
That came out of one of our partners, but it really just symbolizes what we are looking to do. So the A part stands for, we take a bit of an absolute return orientation in the sense we're looking to make money when the going is good, looking to preserve money when it's not so great. And we're agnostic to what the benchmark are. So we, in fact, actually ignore a bunch of sectors which are big in the benchmark, like private banks, IT, consumer durables, auto, pharma, etc., because we just think these have done very well and every fund has them. But we look at other things. So that's the first part. The B being that we look to invest around basic trends which will become big for the markets in the coming decade, and sort of invest around the future rather than the past. And the C really stands for, we run it in a reasonably concentrated 15, 18 stock portfolio. And we, to an extent, customize it also to when someone's coming in and kind of, manage it accordingly. So that's how the ABC comes in.
And what is the underlying core thesis of this strategy?
So the core thesis is really to look to be in trends, which will play out in the coming years, which also necessarily means ignore the really popular trends. We aim to be a part of the equity allocation of someone. Most funds which we see are sitting in the sectors which I just described, which are about 3/4 of the index itself. So our point is, if someone has to buy us, what's the point of us going and buying those same sectors? You're literally just duplicating portfolios. So do something which the others are not. So we focus around that. At the same time, we don't try and run a very small or mid-cap type of cute portfolio. I mean, very simple reasons for it. The number of players doing it has expanded a lot. The number of stocks has not expanded. So pure math suggests competitive intensity will be very high there. We don't want to compete where others are, brains are all competing against each other. We'd rather be at places people are relatively ignoring. Because when you combine the thing of where growth is likely, which is what I touched upon in that playbook, right, when you move from low income to middle income, and where people are not positioned enough. So which is the fundamental effect and the market effect. And you combine these together, your risk reward is very, very favorable. And you can make a decent amount of money without taking the stress of very large drawdowns and things like that.
So the significant outperformance which Anulekha alluded to is stemming from which part of the portfolio, or which theme which has really helped you, or is it across, or there are certain winners which anything which you want to share so that we get a more granular feel of that?
Yeah, I think it's been different things at different points in time, but outperformance comes from two parts. The more well-known part is, okay, what are you buying and which has done better? The less well-known part is, what are you preserving when the markets are down? So we focus on both. The first part, like I said, different things have worked at different points in time. For instance, when we started out in Jan 21, of course, barring the first 2-3 months where we were just deploying, things were very, very heated at that time.
Right.
So we intentionally took our positions, but kept almost 20% cash.
Right.
Which meant we were not beating the markets. We were staying in line, but we necessarily kept that. So when the market started cracking after October, we had the luxury of deploying money. Metals had been very heated in the early part of 2021, but they'd come off a lot. So we went very big, extra 20% deployment. A lot of that happened in the metal space. That did very, very well leading up to the Ukraine war, etc. After that, the government put in restrictions on exports. Those things happened, which meant inflation started getting curbed. So the beneficiaries of lower inflation started doing better. So some of the industrials, some of our agri kind of names and all of that, they started doing well and participated through this period. Some of the energy names did very well at different points in time. So it's been a mix. We've also, we have a mandate to keep up to 20% cash. So we've used that also when we felt times of stresses were coming, including at the beginning of this year when we just felt, equity was falling through the cracks. And also credit lines globally were getting tightened. So when we heard all that, we took money off the table and therefore rode out the whole Jan to March shaky period. And then, deployed back based on the same thesis, like, where is the choice? People are not coming. So it's been a combo. And I think both are important, making money on the sectors which we think will grow faster and be preserving when.
So one of the trends which you talked about and was in terms of that increasingly, if India is to move from a low income group to a middle income, then people would move from rural to urban infrastructure would be set up. I remember having a conversation some time back around the cold chains and all of that which would need. How are you playing that into into the portfolio, and how does that, or how big or small is that in the portfolio?
Yeah, so I mean, we do play it as part of our agri theme. Like we have 5 themes we play it through. One is the manufacturing ecosystem boosting, where we actually buy the input providers today. We have the agri part where we just recreate the industry. Big part of that is actually the supply chain. So we just look at buying somebody who's a big supply chain player, from sourcing the produce to the final product. And if they're in the food processing space, basically they're the buyer.
Right.
So they're apex of the food chain.
Right.
So that's how we play. They'll make sure things happen. Opportunities, of course, will come up for specific players providing refrigeration and all those kind of opportunities. We've not gone that granular yet. Right. Simple reason, we just think it's still early days for the industry creation process. So at this point, bet on the core parts of the industry, and then go more nuanced as the trend gets a little more, fleshed out over time.
Right. So for investment into a strategy such as ABC, what would be the investment horizon which you would typically need to put in the funds for?
Sure. So what we really investing around is this transition of the economy to a middle income thing, which takes some time. The likes of Korea, China have all taken 10 to 15 years go through this transition.
Somewhat.
Yeah. When that transition also happens, different things play at different points in time. So to play the entire transition, and which is a unique period in any country's history, lots of countries have gone to the middle income level and then been stuck there forever. Right. But this transition is not a very difficult one to make. And we're kind of, pushing that. So you want to be playing that as an investor. So to ride it, I think you have an outlook for more than 10 years, when you think about it. But in terms of how we invest, we look to be in the areas which will grow more earlier, and not necessarily in the areas which will grow more later. And I'll give you one example to make the point. Let's say everyone's talking about now this manufacturing boom and all that, but we're not actually going and buying a manufacturer. The reason is that we think a lot of people will come in and set up manufacturing, because the areas they want to bring people in, these import deficient areas, are usually very big in Korea, Taiwan, China. They're usually 4-5% margin businesses. You give them a 5% incentive, people will set up. So the abundance will happen in people setting up. The shortage will happen in the inputs, the power, the energy, the materials, the automation technologies. You always want to be investing around where the shortages are. Right? Maybe in 5-7 years, the shortages don't exist. So that time we would want to be shifting on the other side. So that's how we'll always play things within a trend to try and make more money, because everybody's out there to make money in a reasonably healthy way throughout. Why I also touched upon that currency angle is that when you think about all this, you should be thinking about the next 5-6 years as broadly an investment period. Shocks will come in between when the currency suddenly has a depreciation. And that will usually happen because something is happening globally. Most likely the yuan is falling for whatever reason. So you want to be using those opportunities to come and add in. As we go post that 5-6 year period, as our import demands come down, the currency starts strengthening and the world starts putting more money in. And maybe we even have crazy spikes at that time. So you really want to be looking at that longer cycle to play. When it happens, no one truly knows, but 5 to 6 years is the typical period it takes to set up capacities and go from there.
So my final question to you before we open it up to the audience for questions which they may have is really in terms of performance. We spoke about outperformance. I'm sure there would have been some good days, some bad days, some successes, some failures, because it's never in our journey we have realized that it's impossible to be right all the time. So would you want to give some sense of what your journey has been around managing at this point of time to be right up there on the charts?
So I think we never number one in any month. So we never really even talk about these things too much, because I think focusing on performance takes away from the actual process of going it. We've just focused on the process. which is you want to be buying areas which are relatively less owned and where the whole domestic as well as global ecosystem is supporting those areas, because you're just setting yourself up for success. On a day-to-day basis, what we truly do is risk management, which is when a portfolio's investors brought in money, which are the stocks out of our 15, 16 names we want to be adding to aggressively, and which are the ones we want to be going slow, right? Because nothing will ever work together. And then periods in time where macro issues will happen, and you'll just have to. That's what we've just focused on, and that's resulted in roughly doing a 20% CAGR at a very aggregate level. The early portfolios are actually 2-3% more than that, because at an aggregate level, the way we are supposed to do it now, every account coming in gets added, and because we by default don't go and buy everything on day one, we take 3-4 months to deploy. So it automatically means when inflows come, we have
a lot of cash.
Which is there. So our performance is also with roughly 20-25% cash.
Right. So it's been extremely impressive, and as I said, it's a journey, and I think we are looking at it from a journey of the next 10 years, not necessarily that what has happened thus far. What has happened is history. I think what is ahead, and we remain as bullish. Thanks a lot for your time. Thanks, really appreciating the discussion. I'm sure the audience here also had something to take away from here. Yeah. But we are not going to let you off so soon. So we are now
have a Q&A.
From a question and answer, and if either people can unmute themselves and ask the questions, or if Rinika or Ayushi, if you can read out the questions which are there, then we can try and answer that.
Hi, so we have received 3 questions in the chat box. One is from Mr. Ravi. He wants to ask, what is the view on real estate sector and the defense sector?
Okay. So real estate itself always benefits from infra creation. As you build highways, you build new townships and all of that, which is kind of happening all over India. There will be growth by default. With RERA coming in, it was also a huge benefit for the large players because their cost of capital is very attractive, 8-9% or whatever which they pay, versus middle tier or smaller players who are paying anything from 10 to 15% more than that. Basically, there's no game for them. So just when India is starting to go through this entire urbanization process, and you have such an advantage to big folks, and just to set a bit of context, not like we are the same as China, but 10 million square feet, 12 million square feet is what our biggest players produce and sell in a year. The big Chinese companies do 450 million square feet a year. We are not China, so let's keep that in mind. But the gap is just so vast. But interestingly, in that sheer amount of sizes of apartments, whatever they produce, 90% of it is still 1,500 square feet apartments sold at the equivalent of 15,000 rupees per square feet. I'm talking about China here. So it's not that out of whack with what it is in India adjusting for PPP. And also the culture and propensity for real estate is almost identical to what it is in India. Right. So I think the sizes of the players will grow bigger. If your question is real estate, specifically prices going up, not going up, I think it's a very, very local thing. So, if whichever areas you are in and where it goes from there, I think that may not be contextual here. But from a real estate player's point of view, we're fairly bullish on that space overall. Of course, there will always be periods where they'll run up crazily. And
real estate is cyclical, and there are periods of up and down cycle. I would think that in a phase where there is likely, and as US dollar faces some good pressure here and there, the real assets, including real estate, I think after a down cycle of the last many years, real estate will have a bit of an uptick as compared to normal. So if average, it's slightly be on the higher side. But yes, again, as you said, it's contextual to the local locations, and as a segment, it is much better placed as it was in the last decade.
Yes, and the big advantage to the big developers. So that's what's actually available in the public market. So I think there's a longer journey for them still going on.
In fact, for some of the high yield debts, so some of the developer funding which is there, while one has to be very careful around that. But we have indeed tied up with one or two, and we are offering to our clients some high yield debts, which offer very significant marquee names who have been there for 25, 30 years. And that's something which we think is a place, especially given where debt levels are, something which could be interesting and useful in the decade to come.
Yeah, that could. And I think the second question was on defense. So, firstly, they've had a great run. Okay, we didn't necessarily participate a whole lot in that run. I mean, we did keep it in our thing, and it was probably a little bit of a miss. The one thing I struggle a bit in that is it going to be an area where the public sector will do better, or is it an area where the private sector will tend to do better over time? And what's the trend you kind of want to go behind?
Right.
Which means, will the public sector firms over a period of time become the MTNLs of the world? Or will it actually keep growing? And I'm not very clear on the answer to that, and which is why I've sort of kept away. We've got one or two names on the private space which do participate on defense. So it's definitely an area of interest, given just the scenario. But it's one which is, we just think it's a little trickier than, and maybe the first trade is already done. The next trade will just, have to see. Not to say we might not be in it tomorrow. That could happen. But
no, I think it's again, my own perception is that it's a space with Atmanirbhar Bharat, as they say. It's an area which is of focus.
It is.
But these are longer term trends. Like, it's not something which is a short term trend, because setting up facility, building which is world class, transfer of technology, there are many things involved into it.
Yeah, many things, many geopolitical issues, and also their earnings will never follow uniform cycles.
That's right. It'll have its bumps up and down.
Yeah.
So is there an opportunity? The answer is yes. Which is the opportunity? $1 million question, and we will continue to rely on fund managers who will spot it for us. And I think it will be a trade which we will hear a lot more of in the next 5 years, 7 years. And I'm sure we will benefit from it. How exactly is still unfolding out. One trade, as you said, is already done. The next trade, which will happen, when, how, is something which we will be very, very focused on.
Thank you for answering our question. We have another question from Mr. Ram Prakash Ketan. So he says there are a lot of discussions going around the semiconductor manufacturing in India, electronics manufacturing. So what is your view on this?
So, look, semiconductors is a very, very complicated industry. I've actually spent a lot of time looking at companies there because I used to do Asia before. They're also notoriously low margin businesses unless you become either the likes of a TSMC, which is the big foundry for everybody, and just out of sheer size, it's able to do that. Or you become a brand like Samsung, where you're basically able to integrate your production to a final branded product and improve your margins. Otherwise, it's a notoriously thin margin, high capex business. I think we're also some way away from setting up anything here. I think people will scope out, come in, there's a lot of requirements. The one single easy way to play it is power. The sheer requirement of power when you're setting up a semiconductor plant is humongous. The second thing is actually clean water. I don't even know how to truly play it at this point, but power to me is the easy way to think about it.
I think the environmental requirement of water and it is also humongous. So it's not an easy one. I'm sure none of these are easy ones. It's strategic. I think there is. So it's not a quick win. It's from an India perspective. From a global perspective, of course, the semiconductor prices moved a lot. Any geopolitical pressures in Taiwan, China will have a bearing. US wants to onshore some of the production. So the bigger trends globally will continue to happen. But India as a player of significance is still some distance.
Yes, and also semiconductor earnings are very volatile because the cycles are very, very volatile. You play 1 to 2 year cycles in that. So it's a tricky business, and it's a long chain of things because semiconductor is just the start. Then you kind of go into testing, substrate, packaging, all the way to the gadgets, the panels. It's a huge
I think if the
ecosystem.
EV explodes, again, the requirement or demand for semiconductor is not going down. It is only going to go up. So therefore, it's something which we will have to watch out for. Hopefully, something will nudge it faster than what it looks like currently. But that's something again, one will have to be.
Yeah, and I think the other thing to keep in mind is this recent development on superconducting at room temperatures, which I think can change the whole energy dynamic and all of that around semiconductors. But that's, I think, all of these are some way away. So to me, clearest play is power. Right. Fair.
Thank you for answering our question. Moving on to a question put forward by Mr. Chitranjan. He wants to know your view on the impact of impending national elections, what will happen to the markets, and political continuity and stability. Will it have a positive effect?
I mean, I think it's a given.
Surely an easy question to answer.
I think the fact that political stability and continuity helps, I think that's a given. I don't think even the opposition truly believes right now that they can actually win anything. So I don't know how much of that debate may be relevant. I think the way I see these things is fairly simple. Are we rallying into the elections or are we not? If you're rallying into the elections, you usually want to be taking chips off the table a little bit. And if you're not, and we're just going through a fairly, gloom and doom period, then I think it's just setting up for a nice rally after that.
Our experience was been and that elections provide a bit of a tailwind or a headwind in the short term, but medium term it doesn't really matter because eventually the market is driven by earnings growth, and earnings growth is something which the whole trend which we were talking about the next 3, 5, 7 years, which is it's fairly difficult for a political party either ways to really disrupt it too much. So they can add a few tailwinds or they may not add a few tailwinds. That's so therefore it will just be a question of whether in the run up to the election you will get a buying opportunity or not. You may get a buying opportunity if the market perceives that the results are not in line with what the market expected, whatever be it in terms of A, B, or C. But so you can get a buying opportunity, or you may not get a buying opportunity if the market perceives that the results are aligned to what they want it to be, and therefore then in that case, post the election there will be some bit of a stagnation because eventually it has to catch up with the earnings. So it's a question of before elections or after elections. Eventually, if you have a 12-month horizon post elections, I don't think the elections will make a dent. Sorry, the other part of the question, was there anything else part of it I missed?
Yeah, if political continuity and stability will have a positive effect on the market.
We answered.
So that. Yeah, so moving on to the next question from Mr. Abhishek Sahai. He has 2 questions. What's your take on the Indian tech stocks over the horizon of next 3 years?
I have not had IT stocks, and I'll tell you the reason I have not had it. It has worked out well, but I don't know whether my reason is necessarily why it has worked out well. I've not had it because it was, again, a fairly big sector in the index. It had been doing well for a long period of time. So we just thought, everybody already owns it. Why do we need to own it? My second thesis on it was they're outsourcing companies. But if tech is becoming core to every industry, what do you outsource? Or, you will outsource some things, but a lot of your core you probably keep in-house. And maybe the things which are not so critical to you outsource it, which means that you probably don't make 25-26% margins on that. You may still have a lot of business, but it could be more like a 13-14% margin business, which is what the likes of IBM and Accenture run. Every major client which these firms have are also setting up, if they haven't already set up, their India dev centers, where they're actually hiring coders into it and all that. Now, all of this is in pre-GitHub Copilot world. Post-GitHub Copilot world, I think the one part which is reasonably clear is that the ability by which you can get more things done by less. And if the business model is a bit around man hours into billing rate, then how does that work out in this new world? Not to say that they will not probably find a way to make it work, but it's a little tricky. So that's why we've stayed away. I think it's a more consensus opinion now to stay away, which wasn't necessarily when we originally stayed away, but we've not changed our position on it.
So the follow-up question on this is, what is your take on the new age companies like Paytm, Zomato? Do you have them as part of your portfolio?
We don't. Very specific reason again. About 10% of our portfolio is actually directed towards the digital build of India. 90% is that whole physical build we were describing. But there's a set of things which are happening. It started with UPI and Aadhaar, which was digital ID, digital payments. The next step are 3-4 integral things for creating a digital economy, which is account aggregator. Get a lot of your assets, liabilities, GST data in one place. Then do digital credit appraisal on it and digital lending against it, which is a protocol called OCEN. And then you have a marketplace, which is ONDC. So aggregation of data, credit appraisal, credit disbursement, and marketplace. That's digital economy. What's left is trust, which will come from blockchain protocols. It's a protocol called Badal, which will get implemented. And then there'll be the central bank digital currencies, which will flow through this entire ecosystem. But this architecture will take about 4-5 years to get created. Now, the issue is this: when these tech-based platforms, if you think of it, the way the architecture is being built is central platform is publicly owned. Private players come and participate on it. This could be disruptive for existing players who've already tried to build platforms. Some others could benefit from it. The key will be how many of them are able to survive 4-5 years when they may not be able to make money because the entire ecosystem just doesn't exist today. So we're playing it in a smaller basis and through a firm which already has profit. So that's the least of the issues to do that. But we stayed away from a lot of these firms because I think they're still very far away from.
Again, this would be slightly unfair question to Debashish because clearly he's running one PMS with one strategy. So therefore, it's not that every thing, then the whole essence of the strategy would be. So there is merit in this space in the short term or medium term. There has been a fair amount of correction in the space of new age companies. And we do cover that through various other products which are there in order to do that. But clearly that's a high risk opportunity. There will be winners, which would mean that some of the winners will get more. Of course, they come with their risk. So in that sense, that's a space only somebody who's willing to look at it from a disruptive opportunities, looking at it in terms of fast scale up, and some of them will have mortality and profitability issues which go hand in hand with that will be there. So therefore, it's a more nuanced area which we would need to look at, and we would need to continue to do.
And yeah, I think also to your point, Amitabh, I think a lot of it is about what is your mandate and what is your time horizon.
That's right.
We don't do it because we have a specific thing in mind and where we don't want to keep shuffling stocks around all the time. That doesn't mean that trading opportunities will not come in, many of them from time to time.
And probably it may be better to cover it through a diversified strategy of a mutual fund than from a concentrated PMS, unless you're going into venture capital kind of a fund. So we, just to tell our audience, we do have AIFs and venture capital. We do have mutual funds, which we do for recently listed IPOs, etc., which are basically new age tech companies, a lot of them, etc. So the products are there. It would depend on which ones are there, and these come with fair amount of risk. And somebody who invested in this 2 years back has had a terrible experience. But that doesn't mean that the experience would be as terrible going forward as well.
Yeah, so we have a follow-up question from Mr. Ravi. He wants to know what would you play on hydrogen or electric for the future in the automotive sector?
Hydrogen is, I wouldn't necessarily link hydrogen for the automotive sector. I think it's more the production of hydrogen and bringing that cost down to make it viable. Different ways to play it. There are the large folks, the large energy related companies who are obviously focusing on this space. We do have those in the portfolio. It may still take some time. to be honest, for hydrogen, and to have it as a viable solution at the right cost. On the EV space, the way we see it is the shortages will happen in the materials for EVs, which is the non-ferrous metals. So we play it through that.
Yeah. I'm glad you were here to answer this question. I wouldn't know the answer.
Yeah, so the next question is from Mr. Alek Gupta. He wants to know what your view is on the energy sector, where we have both conventional oil and gas companies as well as green energy companies. So, which one has a better perspective in terms of short-term duration?
Alek, you are an expert on that, but over to.
I don't know where the googly of short term came in. I mean, no, to be honest, we don't necessarily look at short term. I mean, honestly, in the short term, it probably doesn't matter. Everything is a stock chart and you can play it whichever way. But I'll just give you our thinking around it, which is that I don't think oil and gas or fossil fuels are going away anywhere. I think the transitions or whatever is being talked about is going to take a good 15 years to really happen. But there are multiple ways to play the transition. If you think of it as a business owner, actually the ideal thing you would look at is there is a transition for which I have to do large capex, which means I need cash flows. Cash flows come from traditional energy businesses, not from new age businesses. New age businesses, however, can give you valuation. So if as a business owner, you're able to separate out your new age businesses into one entity, which you do strategics, you do say, IPOs of it, whatever you may do, you'll get valuation out of that. But the cash flows you need to support it, the low cost debt you need, because all of these are very capital intensive, you need to have a combo of debt and equity. So if you're able to do that, that helps. Keep in mind that thermal energy is a 75% efficiency conversion. Solar is a 25% efficiency conversion. So a lot more solar is needed to cater to it. You need batteries. So it's a fairly complex set of things to be set up. But that's how we look at it. The players who have the cash flow backing and the plans for special situations in the new energy businesses, and you kind of write that.
Next question we have from Miss Ria. She wants to know how exactly a PMS can fit in her financial plan. What do you think is the best kind of profile for somebody to have a PMS in their plan?
So I think, firstly, it's a private discussion.
So let me try and address the first part of it, and then you can take it. Clearly, we believe in asset allocation. We don't like concentrations. So the PMS by regulation is a minimum investment of 50 lakhs. So therefore, typically when you're looking at even a 25% concentration, if you have about 2 crore portfolio or so, that's where PMS starts fitting in. And the reason for that is that these are concentrated strategies. And as Debashish was mentioning in terms of the performance as well, that you are looking at higher returns, but it does have a short-term downsides which could be there. So therefore, the regulator also doesn't want people to put the entire money into a PMS. They would want it to be well diversified, and PMS could be that portion of the portfolio where you're looking at alpha, where you're trying to generate and create return. So therefore, from a portfolio perspective, clearly PMS is something which is, you're looking from an equity perspective, which you're looking at from a portion which is 20 to 25% of your allocation at max, 10% even better. And then just try and write that out. Anything you want to add on to that?
No, I think that's fair enough, because mutual funds are obviously a more tax efficient product. So to the extent that your core equity allocation is taken care of through, portions of the mutual funds, that should always be your first port of call. And then you kind of look through what is it that the mutual funds are doing or what is it that they're not doing. And that's how we set up our thing, and probably that's how you should look. If a PMS is going to do exactly what a mutual fund is going to do, I don't think it makes sense.
Okay, thank you for all your energy. We have last question to go to. Maybe Amitabh, you can help us answer this better. This is a very specific question. So, Mr. Karthik Vishweshwaran is asking, do debt funds continue to make sense for investors anymore with the new taxation norms, making it really hard to have major benefits? For example, you have other equal fixed return instruments, bets, or even low risk equity products like arbitrage asset allocation funds. So, and other than the equity liquidity aspect, what is the benefit of these funds for the highest taxpayer?
So the answer is yes. Now let me try and first of all, as we said, you work on asset allocation. Each portion of the asset allocation has a certain role and in the portfolio. Of course, with the change of taxation, the benefit or the attractiveness of debt has gone down a bit, but it is not. It's not that it is of no use. There is still a lot of things to go by. As you mentioned, whether you look at so you would now bucket debt into shorter term, medium term, longer term. In the shorter term, of course, some of these are much more liquid. So when you compare with, you have to compare it. What would you put it otherwise like in? For example, if you're looking at less than 1 year horizon, the most liquid form of investment would be debt because you typically don't have exit loads, etc., and you would be able to arbitrage. You mentioned in the question itself has equity taxation and has debt-like nature, and therefore that kind of you have a tax rate of 15%. So for shorter term, you could look at arbitrage, ultra short-term funds, or various other modes which will help. When you start looking at longer term, where debt used to have a significant advantage, now there is still a, if I may use the word loophole, or whether you may say an opportunity. You have, if you have equity between 35 and 65%, and then in that case, you still get indexation benefit like in the past. So there are several multi-asset funds today which have equity between 35 to 65% and is predominantly debt, which has indexation benefit. Now, several funds cover this equity through arbitrage, which is debt-like. Therefore, you have eventually a debt-like instrument completely, and you have indexation benefit just like in the past. So earlier, out of 100 debt funds, all 100 debt funds had the tax benefit. Now, there are 3 or 4 funds which do have that tax benefit and have the nature of a debt. And people do it through multiple modes, and we can have a more bilateral discussion where I can run through that. But clearly that, so the earlier benefit can still be done through through a multi-asset, debt-oriented multi-asset fund. Coming back to the third item in terms of longer term debt, again, you have these longer term debts also can have some merit. For example, in a debt fund, you typically have return is a more diversified portfolio. If you look at a corporate NCD, etc., it's a single issuer risk which you are taking. In a fund, you still have a portfolio basket of funds. Secondly, in terms of what you would look at, if you're looking at if you saw in the past, there were a lot of target maturity funds which had worked well, because in debt funds, because of the liquidity, if the rates are going down, which is likely over the next 3 years or 5 years horizon, if you look at, and you need funds in the interim, you could have mark-to-market gain. I don't want to get into the complication of mark-to-market gain on this call, but you could have. And given that we are near the peak of the interest rate cycle and possibly on near the upper end of it, the probability of having mark-to-market gain over the next 5 years would be higher than lower. Anything can happen from a market perspective, but I would say probability would be there. So there could be merit of somebody looking at that aspect of it as well. So I wouldn't say that there is no merit in debt, because so you cannot really put money which you have earmarked for debt in asset allocation into equity, because otherwise the risk which you are taking in the portfolio would be too high. Typically, we say that whatever money you need in the next 2 to 3 years, you would typically put in debt, because you don't want to be caught in a negative cycle of equity, which may happen from time to time. So again, these are generic answers. Specific, we can come back to your needs and figure out what is the right instrument which would be there. But I wouldn't rule out debt at this point of time. Even within debt, sometimes we mix up with debt only being AAA debt. There are AIFs today in debt. which is into performing credit, which are doing very well. We are recommending a couple of them. ICICI and Vibhuti, and there are many more which are there, where we are comfortable with the underlying companies on which you are the underlying exposure is, and the yield there is higher, 12-13%. So therefore, then they are significantly at an advantage as compared to some of the other debt products. But again, this is not for everybody. This is only suitable for somebody who's willing to be in the performing debt space. So from a gamut of products, I think the industry is expanding. The opportunities on debt are significant, and they will continue to be. I'm sure the industry will evolve and many more products will come in. What is suitable is something which is a bilateral discussion which one can find and do. So I wouldn't rule it out at this point of time. So
Thank you. Thank you so much for your answers, Mr. Debashish and Mr. Amitabh. So we are at the end of our question answer session. Thank you for joining in.
Thanks a lot, and thanks Debashish for being a part of this edition. And as Anulika had mentioned in the beginning, we look forward to a lot of feedback from all of you, so that if we, in any of the subsequent sessions, we can improve. If there are any other follow-up questions which you have, please feel free and write to us, mail to us, WhatsApp me or Anulika or any of our team members. We would be more than happy to get back to you. If there's anything else which you want us to detail in more, please again reach out and we will do that. And thanks a lot for sparing the time and joining us.